Hey there guys, how is it going? Welcome to episode number 18 of the FTSE Show with me, Chris Chillingworth. I'm feeling a little bit down and a bit sick at the moment, and amid all the stuff that's going on at the moment, I'm just doing a short, cheap and cheerful episode today because I just don't really have the energy. But I'm alright, I'm fine. I wanted to say thank you to everyone who's been liking the videos so far. Up to episode number 18, that's pretty cool. We've looked at 17 companies so far, and we've listed them as per the point scoring system, but also gone deep into their numbers and identified which of these companies are good long-term investments and which of them are clearly not. If you haven't done so already, I would massively appreciate a like on this video. The more likes we get, the more people that get to see the video, the more people that get to see the video, the more we get out there basically, and this show gets seen by more people, which is ultimately, why I'm doing it. I do this analysis anyway. I do it in my spare time. I've got a team of people that work for me that do a lot of this for me and send me in the reports, and then I analyse the data and identify these companies. And at the moment we're trawling through 1,440 FTSE companies, including the FTSE 100, the 250, the small cap, the fledgling, and the FTSE AIM markets. So we've got a lot of stocks to go through, and at the moment I think we've just hit our 150 mark on the companies we've so far analysed, starting from the FTSE 100 and working our way down. So we've got a lot of work to do, and it's exciting because who knows what we'll find, which companies we're going to crop up and identify as fantastic investment opportunities. We are doing a course which I have built, and I've spent the last week doing it. It's a 6-week course, and it's going to be guiding people how to identify and analyse these companies, and also how to build a long-term investment plan. So how do you go about buying these companies? How much do you pump into these particular stocks? How often do you buy them? How much do you spend? All that kind of stuff. If that's something you're interested in, you can just email me at chris@thecleantrader.com. Let me know you're interested. I'll put you on the list, and as soon as the course is ready and out, I will give you a shout. That's it, really. And then if you want to buy, you buy. If you don't, great. No issue. Today, we're going to look at a company called Easyjet. Today, they announced that they were grounding their entire fleet amid all of the virus issues and stuff that's going on. And it's looking like it's going to be a bad 2020 for all of the airline companies, amongst many other businesses. Coluccio's and Bright House PLC both went under today, pretty much went into administration. Both relatively weak companies. Easyjet are a far stronger company than both of those, but we're starting to see the weakest die off right now. And it's interesting to have a look and see whether or not Easyjet are going to be eventually part of that or not. So that's one aspect of what we're going to be looking at today, is do they have enough about them to weather the storm over 2020? Because it's going to go on for a while, especially with all their planes grounded right now. Share price has plummeted from £15 a share to £5 a share roughly. So it's quite a drop. And the question here is therefore, as well as can they weather the storm, do they make a good long-term investment? And that's what we're going to find out today. So we're going to dive into the numbers, we're going to find the answers to those questions, then we're going to jump back here and take a look at where they sit on the leaderboard. So looking at the revenue's looking really strong, right? Since 2008, and we can include 08, 09 in the financial crisis. So it's always good to kind of get a previous crisis, if you will, a previous crash, incorporated into the numbers just to see how they were doing during that period. Gives us a bit of perspective. Obviously, the events of February, March 2020 are very different to the actual events of the financial crisis and the banks failing, but it's useful to kind of compare the two. But looking at the revenue, we've seen step on growth on growth every single year, pretty much, apart from 2015, 2016 when we didn't really see much growth at all. But consistently over the last 12 years or so, it's been pretty solid, going from 2.3 billion to 6.3 billion over that period of time. So we can definitely say we've got some revenue growth going on there. Looking at expenses are very high. We're looking at 84.8% of the gross profit being eaten up by the 5.4 billion in expenses. So they're bringing in 6.3, they're spending 5.4 just on selling, general and administrational expenses. That's very high. Doesn't leave them with a huge amount of play and a huge amount of room. So that's a concern. I don't like high expenses. If we were seeing high expenses but we were seeing a consistent drop in those expenses, i.e. the future was looking to be a bit more brighter perhaps, and they were making some solid reductions in that, then I would be a little bit more keen. But we're not really seeing that here. I mean, we're talking 85%, aren't we? Well, we were seeing 85% or just less than in 2013. So we can definitely say the last 7 years they've pretty much been stuck at that level, not really falling. Certainly no obvious consistent sign of continued year-on-year decline in the cost of expenses. So that's not so good. We've got depreciation costs, as you'd expect from an airline company, but they're at a level that I wouldn't be too concerned about. We're looking at about $500 million a year being eaten up by depreciation and amortization costs. That's all right. For an airline, you'd expect something. And then interest on debt has been rising, but to be fair, you could say it's been rising since 2014 to 2019. So we're looking at the last 6 years, we've seen definitely growth in that area. So that would indicate they're probably borrowing more and more over the last 6 years. We'll look at that in a moment. But it's at a level that, again, comfortable with, not a big issue. We're talking about 36 million there, which is fine. So they've got operating profit at this point of 466 million. So that's all that's left of that 6.3 billion. By this point, we've got 466 million. Then we remove the interest on debt, so that's taking off another 36 million. So it's leaving them 430 million. Then we've got taxes to come out of that as well. What they're left with net earnings wise is 5.5%. 5.5% of all the revenue that comes in is profit for the shareholders. That's low. That's not cool. That's not enough for what I would be interested in. We've seen higher over 2013 to 2016. They were knocking on the door of 10% a year. We're now seeing, the last 3 years it's dropped us from 6% down to 5.5%. And we can expect 2020 is going to be a tough year on Easyjet, can't we? Bear in mind they're grounding their entire fleet. Could well be the first losing year for them for a long time. So that's a concern, in so much that I'd be interested to see, do we think Easyjet are going to survive this? Which is quite a big, bold thing to say. But there are companies already going into administration, albeit weaker companies. I think Carluccio's went today, and Brighthouse went today. Like I say, weak companies. They weren't particularly strong businesses. Certainly not setting the world alight in their brand and what they were doing. Easyjet are a much bigger company. But if it continues this way, we might see some bigger names dropping out. So it's interesting to have a look at this now with a kind of second lens to see whether or not this is a company that are likely to be able to do well. So we're looking at, or do well in this period, so we're looking at about 349 million in profit per year out of the 6.3 billion that comes in. So it's not great. It's not, a company bringing in 6.3 billion and only keeping 5.5% of it, it's not brilliant, it's not terrible. There are far worse companies out there to be putting your money into. Many investors do. But this isn't the worst company. It's certainly nowhere near the greatest either in terms of the profit that they make. Coming down to the balance sheet, they've got relatively strong cash, 1.2 billion in cash sitting there. That's going to bode well for them in 2020 in terms of digging them out of a bit of a hole. I'm interested to look at the property, plant and equipment. Assets are very high, as we would expect, with a ton of airplanes in their fleet. So looking at 5.1 billion in terms of non-current assets. Now, you can't turn airplanes into cash very quickly. So that's not cash necessarily that they're going to be able to get their hands on pretty quickly. It's not liquid. Whereas obviously cash is money owed to them by other people, is we've got derivative financial instruments. So yeah, some cash there. Current liabilities. So short-term debts, nothing. So that's great. They've got no short-term debts that need to be paid within the next year or so. So that's pretty good. They do owe 1 billion in unpaid invoices, if you will. It's money that's owed to other people from Easyjet. Long-term debts, we're looking at 1.3 billion. So this is debt that's got to be paid over the last a year or older, essentially. So it doesn't have to be paid for at least a year. So how do we justify, or how do we kind of work out whether or not that's too much or too little? Well, the way I do that is I look at, right, what's the debt compared to the earnings power of this company? So how much are they making consistently against how much are they borrowing? And are they biting off more than they can chew? How long would it take them to pay off that debt based on the money that this company is bringing in terms of profit? And that works out 3.8 years, which is fine with me. I'm totally cool with that. Hasn't been as good previously. This is when they weren't making anywhere near as much money, and the debt was still the same level. Debt's pretty much stayed around under 1 billion the whole time, on a consistent basis, but back then they weren't making anywhere near as much, and so therefore it would have taken them longer to pay off that debt. These days they've got more earnings power, so they're carrying the same kind of debt, but they've got more earnings power to be able to pay it off. So at the moment, that's all right. I'm relatively happy with that debt level. Obviously it'd be great if they didn't have any debt, but the debt level isn't to an extreme that I would be particularly worried. And then we can come down to retained earnings. Now, retained earnings are basically a pot of money that the company will be pumping money into. And this is typically, there's a couple of different ways you can spend the shareholders' profit. Most companies will pay a dividend. So a certain percentage of that money, or that profit, will be paid out in dividends to reward current investors and to attract new investors. Some of that money is going to be spent on buying more assets, maybe some more aeroplanes for the fleet, whatever. And you would therefore expect that those assets to bring in a higher rate of profit for the company. I.e., if you're buying aeroplanes but it's costing you more than what you make to run them, then you wouldn't buy more aeroplanes. So we would expect, that's a decent place to put your money, is to buy more aeroplanes and make more profit as a business, if they can make that work. And then the other place they can put it is to buy back their own shares, so reduce the number of shares that are currently out there. And reduce the concentration, or improve the concentration, I should say. And that can help, because that can increase the shareholding percentage of the existing shareholders, and it also raises demand, which can drive share price up. They've not been doing that. They've not been investing in shares. They have been investing relatively heavily in property, plant and equipment, which you'd expect again from an airline company. Nearly $1 billion a year in the last 2 years, so they've been pumping some big money into it. But what I really like about Easyjet, and I think why I think Easyjet will be okay, is because of the retained earnings. So the other thing they can do is they can pump money into retained earnings. This is the Warren Buffett way of doing things. This is that, Warren Buffett would have cancelled all their dividends, and there would be no paying no dividends if it was Berkshire Hathaway, which is exactly what he does. But the remaining profit that's left over, he pumps into the retained earnings, and they use those retained earnings to invest in other companies like Coca-Cola, Gillette, whoever, Apple, American Express. That's what Warren Buffett does. And so his company are investing in other companies that are profitable and making loads of money, and that in turn makes Berkshire Hathaway very profitable. It's like a savings pot, and it can be used for acquisitions of other companies. It can be used for buying stocks or shares in other companies, and it can be used for a rainy day fund. And Easyjet have 2.2 billion sitting in this pot, and they've been growing that pot consistently as a matter of tradition, if you will. Over the 2008 to 2019, every single year they have pumped money into this pot. The question is why? Why have they been pumping money into that pot? Well, we don't know their strategy, or I certainly don't know their strategy as to what's actually going on over those last 12 years and why they've been doing that. Most companies are doing that so that they can acquire opportunities when they come up. So if an airline's struggling and EasyJet want to jump in and buy them out, then they've got the money to do it, sitting there. That's what it's all about, really. But they may have to dip into this with this whole 2020 crash in the market. The airlines are grounded because no one's travelling. They've got 2.2 billion sitting there. So if they have a bad year and they lose some money, which in 2008, 2009, they were looking at still being a profitable business during the financial crisis back then. This is obviously very different. Their planes are grounded. They're not making any income. So this is going to cost them, bear in mind, their expenses are at 5.4 billion. And they're going to be making little in the way of income over 2020. We're hoping, obviously, that planes might be back in the air, maybe towards the end of the year. but it could be painful, but not as painful. Bear in mind that they have the ability to take on more debt, and they have 2.2 billion in retained earnings sitting there. So I think EasyJet are going to be okay. I can't guarantee that, but as a business, I think there are far weaker companies and far weaker airline companies out there than EasyJet. So to answer the question of, are EasyJet going to be around at the end of this? I think they would be. I think they've got enough strength in them to be able to do well, to survive this and go through. I think there are other companies that do not have that ability, though. We may lose a few airlines along the way, but that's just speculation. I don't know that. I'm just talking about some comparisons that I've seen with some companies and some of the weak numbers. EasyJet are not one of them. I think EasyJet are looking okay. In terms of actually, do I think they're a good long-term investment? Well, this is not a company I would invest in, first of all, because I have a very strict criteria about what I want to see out of a business. Certainly prior to 2020's events, I would want to see some very, very strong numbers prior to 2020, and we've not been seeing them. So they're not a terrible company, don't get me wrong, but they're not great, and I'm only investing in great businesses. So for me, EasyJet is not a purchase. However, for those that are opportunists looking for a good opportunity, we look at EasyJet's chart here, and there may well be a decent opportunity to buy some EasyJet shares on the cheap right now. PE ratio is 6.7, which is very low. It means that the price is a very attractive price right now. Currently trading at £5.50, the price that it was sitting at in 2012, so they've dropped back 7 years. It's been a decent growth stock from 2008 to prior to 2020, going up from about, where were we in 2008, probably looking at around £4 a share to £15 a share over that time. So it's been okay. It's been a decent growth stock, not fantastic, not quite as good as some of the other companies that I'm holding, but okay. And I guess that is the story of EasyJet. Here's an okay business that's doing all right. Not a company I would invest in because they don't make the grade, but not terrible. They're much better than some other companies that we've been looking at. So the last thing to do then is just to take a look and see whether or not these guys make it onto our leaderboard and what score they achieved. Okay, welcome back. So, not a bad company, not a particularly great company. They are not a business that I would personally be invested in. There are far better companies out there for me and what I'm looking for in terms of long-term growth stocks. Probably going to be able to weather this 2020 storm. Maybe there'll be some cuts along the way just so they can get there, but that 2.2 billion in retained earnings is going to help them. Unfortunately, this is a business with very high expenses. I think it was 5.4 billion. With no income coming in, there's a lot of outgoings. So I would imagine EasyJet are going to have to make some cuts of some sort just to weather the storm. I might be wrong. But I think they will survive. So we'll see. So we've run them through the point scoring system. This is the same point scoring system that we put all of these companies through. This is a measure of the score is essentially a measure of all the key measurables that I'm looking for in a stock. So there are a lot of data. There's a lot of data in the financial statements I'm not interested in. There are some key areas of information that I'm looking for, and we mark heavily on that. We give if they meet these scores, then they get high points. If they are nowhere near it, they get negative. And so this is why some of these companies are nowhere near what we're looking for, and some of these companies are doing very, very well and are exactly what we're looking for. EasyJet scored 15 points. So we just chuck them up on the board then. Okay, so 10th place on the board. Pretty much exactly what I was saying in the analysis. So this is a company that they're not particularly strong. They don't tick all the boxes that I'm looking for in a growth stock. But at the same time, they're not a bad company. And you will probably do okay if you have EasyJet in your portfolio. If you buy the shares at cheap enough, and right now at £5.50 a share, I would probably, there is argument there that EasyJet are a decent opportunity right now. They're at £5.50 a share. You know, once they've recovered over this period, 10, 20 years time, that could be a very strong pick. right now for me, I'm not interested. I'm not really interested in the short-term opportunities. I'm looking for big, solid companies that hit all of the boxes, tick all the boxes for me. I'm only invested in those particular companies. All of those companies' share prices are low as well right now as a result of the ongoing events of 2020. So I'm putting my money into those companies. I'm not putting my money into Easyjet. Love to hear what you think. Please leave a comment underneath if you've got anything to add to the video. Thank you so much for watching, guys, and I'll see you in the next one. Cheers.